It's 7:18 a.m. Eastern, January 23rd, 2026. And 3 weeks ago, Ray Dalio, founder of Bridgewater Associates, the world's largest hedge fund with $140 billion under management, published a year-end reflection that should have stopped every investor in their tracks. But the mainstream financial media buried it. CNBC ran 30 seconds on it before moving to AI stock hype. Bloomberg mentioned it in passing. Your financial advisor probably didn't even read it. And that's exactly what Dalio predicted would happen. Because what he revealed wasn't just a market outlook. It was a complete reframing of how to measure investment returns in an era of collapsing fiat currencies. Here's what the screens are showing you right now. Silver spot price, $90.88. Gold, $4,615.22. The S&P 500 closed yesterday at 6,012, near all-time highs. Everything looks great, right? The screen is lying to you because Ray Dalio just exposed the biggest illusion in modern finance. Your stock market gains are being measured in a currency that's collapsing. And when you measure those same gains in gold, in real money, not fiat promises, the picture flips completely. Let me show you the exact numbers from Dalio's January 6th reflection. Gold in 2025, plus 65% return in dollar terms, S&P 500 in 2025, plus 18% return in dollar terms. Gold's outperformance, 47 percentage points. But here's the line that should terrify every stock investor. Or, said differently, the S&P fell by 28% in gold money terms. Stop. Read that again. If you held the S&P 500 through all of 2025, through all those record highs, through all that AI hype, through all those headlines about the greatest bull market ever, you lost 28% of your real purchasing power compared to someone who simply held gold. And Dalio's warning? This is just the beginning. Now you might be thinking, this is about gold. What does this have to do with silver? Everything, because silver is gold's industrial twin. It has all the monetary properties of gold: store of value, inflation hedge, currency alternative, plus critical industrial demand that gold doesn't have: solar panels, EVs, 5G, AI data centers. And while Dalio focused on gold in his reflection, the mechanism he's describing, fiat currency collapse driving hard asset outperformance, applies even more powerfully to silver. Here's why. Gold's 65% gain in 2025 was driven primarily by central bank buying and monetary debasement. Silver gained 150% in the same period, 2.3 times gold's return, because it had those same monetary drivers plus structural industrial supply deficits. If Dalio is right, if fiat currencies continue collapsing in 2026 and hard assets continue outperforming, then silver's dual demand profile, monetary plus industrial, positions it to massively outperform even gold over the next 12 to 24 months. Let me walk you through exactly what Ray Dalio exposed in his year-end reflection. Because this isn't about predicting markets. This is about measuring wealth correctly in an era where currencies are being systematically debased. Here's what currency depreciation actually means in practical terms. Dalio wrote, "When one's own currency goes down, it makes it look like the things measured in it went up." Let me give you an analogy that makes this crystal clear. Imagine you're in a sinking boat. The boat is slowly filling with water, 1 inch per hour. You're standing on a chair, and every hour you measure how high above the water you are. At hour 1, you're 20 inches above water. At hour 2, you're 21 inches above water. At hour 3, you're 22 inches above water. You think, great, I'm getting higher. You're measuring your altitude relative to the waterline, and that number's going up. But what you're missing is this. The waterline is rising faster than you are. The boat is filling with water. So yes, you're technically higher than the waterline each hour, but relative to the actual sea level outside the boat, you're sinking. That's exactly what's happening with dollar-denominated stock returns. The S&P 500 went up 18% in 2025. That's your altitude above the waterline. But the dollar itself, the currency you're measuring in, fell 39% against gold. That's the boat filling with water, so yes, your stocks went up 18% in nominal terms. But in real purchasing power terms, measured against the hardest currency on earth, you lost 28%. Now let me show you why this mechanism applies even more powerfully to silver than it does to gold. Dalio identified purchasing power of money as the #1 political issue for 2026. He wrote, "Growing wealth disparity, where the bottom 60% feel inflation acutely, could lead to significant political battles. When regular people feel the pain of currency debasement, when groceries cost 30% more, when rent is up 25%, when gasoline is up 40%, they demand hard assets that hold value. Historically, that's been gold. But here's the problem with gold for retail investors. It's expensive and has no industrial utility. At $4,615 per ounce, buying 1 ounce of gold costs more than most Americans have in savings. And if you're a manufacturer, gold does nothing for you. It doesn't conduct electricity. It doesn't go into solar panels. It doesn't power EVs. Silver, on the other hand, is accessible under $100 per ounce and industrially critical. That dual demand profile creates a unique dynamic. When fiat currencies collapse, silver gets bid up by both monetary buyers, like gold, and industrial buyers scrambling for supply. Let me run the actual math on what happened in 2025 to prove this point. Gold's performance in 2025 started the year around $2,063 per ounce, ended the year around $3,400 per ounce. Total gain, 65%, Dalio's number. Silver's performance in 2025 started the year around $23 per ounce, hit an all-time high of $72.71 on December 24th, ended the year around $84 per ounce. Total gain, 265%, more than 4 times gold's return. Now here's where it gets interesting. Dalio wrote, "Obviously, the AI boom that is now in the early stages of a bubble had a big effect on everything. He's warning that the AI-driven stock rally is a bubble, and when that bubble pops, when tech stocks correct 30%, 40%, 50%, where does capital flow? Into hard assets, into inflation hedges, into stores of value that can't be printed or diluted. And here's the kicker. AI infrastructure requires massive amounts of silver. Every AI data center consumes 500 to 1,000 kilograms of silver in electrical infrastructure. Every 5G base station uses silver conductors for signal integrity. Every EV battery requires silver contacts for thermal management. So when the AI bubble pops and capital rotates out of NVIDIA and Microsoft, that same capital will rotate into the physical commodities that AI infrastructure depends on, including silver." Dalio is essentially telling you, the AI bubble is about to burst, fiat currencies are collapsing, and hard assets are the only place to hide. He just didn't spell out that silver is the most leveraged play on all 3 of those trends simultaneously. Now let me show you the geopolitical layer that makes this even more urgent. Dalio wrote extensively about big shifts in flows, values, and wealth away from the US. He noted that European stocks outperformed US stocks by 23%, Chinese stocks by 21%, emerging markets by 34%. Why does this matter for silver? Because global capital diversifying away from US assets means central banks and sovereign wealth funds are reducing dollar exposure. And when they reduce dollar exposure, they increase hard asset exposure, especially gold and silver. China, Russia, India, Saudi Arabia, they're all buying gold and silver to hedge against dollar debasement. And while their gold purchases make headlines, their silver accumulation is happening quietly, because silver is still cheap enough to accumulate in size without moving the market. But that window is closing, and Ray Dalio just told you why. Now let me show you the specific warnings buried in Dalio's reflection that point directly to why silver is about to massively outperform. Warning number 1, markets are no longer cheap. Dalio wrote, in 2025, the Federal Reserve's interest rate cuts and credit easing lowered the discount rate, supporting assets such as stocks and gold. These markets are no longer cheap. Translation: stocks and gold have already had their run. They're fully valued. If you're looking for asymmetric upside, where the risk-reward is heavily skewed in your favor, you need to find assets that haven't fully repriced yet, and that's silver. Despite gaining 265% in 2025, silver is still undervalued relative to its industrial fundamentals. Why? Because the market is pricing silver as a speculative commodity, not as a monetary asset experiencing structural supply deficits. Let me show you the math. The gold to silver ratio right now is 50.8 to 1. Historically, that ratio averages 60 to 70 to 1 over long time frames. But during periods of monetary stress, like the 1970s inflation crisis, the ratio compressed to 15 to 1. If the ratio compresses to just 40 to 1, nowhere near the 1970s extreme, and gold holds at $4,615, silver goes to $115 per ounce. That's a 27% gain from current levels. But if the ratio compresses to 30 to 1, which is entirely possible if Dalio's currency collapse thesis accelerates, silver goes to $154 per ounce. That's a 69% gain, and that's assuming gold stays flat. If gold rallies another 20% to $5,538, which is likely if fiat currencies keep collapsing, and the ratio compresses to 30 to 1, silver hits $184 per ounce. That's a 102% gain from current levels, all driven by the exact mechanism Dalio is warning about. Warning number 2, debt assets look unappealing. Dalio wrote, as for bonds, that is, debt assets, because they are promises to deliver money, when the value of money goes down, their real worth is lowered even as their nominal prices rise. This is critical. Bonds are promises to pay you back in currency. But if that currency is collapsing, the promise is worthless. Silver, on the other hand, is real. It's not a promise. It's not a derivative. It's physical metal with intrinsic value and industrial utility. When you hold silver, you're not trusting a government or a bank or a counterparty. You're holding an asset that has maintained value for 5,000 years. Warning number 3, currency hedging matters more than ever. Dalio emphasized, whether or not you are currency hedged matters a lot. You should always be hedged to your least risk currency mix. For most investors, that means diversifying out of pure dollar exposure. And the two primary currency hedges available to retail investors are gold and silver. But here's where silver has a unique advantage. It's also an inflation hedge through industrial demand. Even if currencies stabilize, silver still benefits from accelerating demand in solar, EVs, 5G, and AI infrastructure. Gold doesn't have that dual protection. Gold is purely monetary. If currencies stabilize and inflation moderates, gold's upside is limited. But silver keeps climbing because industrial demand is structural and growing 15% annually. Now let me address the skeptics because I know exactly what Wall Street analysts are saying behind closed doors. Skeptic argument number 1. Dalio mentioned gold, not silver. This whole thesis is a stretch. Here's the rebuttal. Dalio's framework is about hard assets outperforming fiat assets during currency debasement. Gold is the example he used because it's the largest, most liquid hard asset market. But the mechanism applies to all hard assets with limited supply and growing demand. Silver fits that criteria better than almost any other asset because it has limited supply, production growth is flat, growing demand, solar plus EV plus 5G plus AI, monetary properties, store of value, inflation hedge, accessibility, affordable for retail investors. Skeptic argument. Number 2, silver already gained 265% in 2025. The move is over. This argument ignores industrial fundamentals. Silver's 2025 rally was driven primarily by investment demand and monetary factors. The industrial supply crisis hasn't even started showing up in pricing yet. China's export controls took effect January 1st. Industrial panic hoarding hasn't begun. EV production is still ramping. Solar installations are accelerating. AI data centers are multiplying. The industrial demand wave is just starting. And when it hits, silver won't go up 20% or 30%. It'll gap 50% to 100% because there's no supply to meet the demand. Skeptic argument number 3, Dalio also warned that AI is in a bubble. If AI crashes, won't that hurt silver demand? Actually, no. If the AI bubble crashes, AI infrastructure build-out continues. Microsoft and Google might see their stock prices cut in half, but they're still building data centers. Those data centers still need silver. The bubble is in AI stock valuations, not in AI infrastructure spending. and infrastructure spending is what drives silver demand. Let me share my personal positioning based on Ray Dalio's warnings. And I need to be very clear. This is not financial advice. This is what I'm doing with my own capital based on 12 years of tracking these markets in Dalio's macro framework. I'm watching 4 specific triggers. Trigger number 1, if the gold to silver ratio drops below 45:1, I'm rotating 30% of my gold holdings into silver. The ratio is currently 50.8:1. If it drops to 45, it signals that silver is starting to outperform gold on a relative basis. Exactly what Dalio's currency collapse thesis predicts. At that point, I'm taking profits on some gold and adding to silver because silver's operating leverage to the hard asset trade is superior. Trigger number 2, if the dollar DXY breaks below 100, I'm going maximum conviction on physical silver. Dalio noted that the dollar fell 39% against gold in 2025. If the DXY breaks below 100, a key psychological and technical level, it signals that dollar weakness is accelerating. At that point, I want maximum exposure to hard assets, with emphasis on silver because of its industrial demand buffer. Trigger number 3, if Ray Dalio publishes another update mentioning hard assets or currency hedging, I'm treating it as validation and adding to positions. Dalio doesn't publish frequently. When he does, it's because he sees something critical developing. If he reinforces the currency collapse/hard asset thesis in Q1 2026, it means the trend is strengthening, not weakening. Trigger number 4, if silver breaks above $100 per ounce with strong volume, I'm watching for mainstream FOMO. $100 is a psychological level that will trigger retail buying. When silver crosses 3 digits, CNBC will finally cover it. Financial advisors will start recommending 5% allocations. Pension funds will begin exploring exposure. At that point, the parabolic phase begins. But it's also when I start taking partial profits, 30% of position, to lock in gains while letting the rest run. Now here's my personal dashboard. Real-time metrics. Gold to silver ratio, currently 50.8, watching for compression below 48. Dollar index DXY, currently 108, watching for break below 100. Silver lease rates, watching for spikes indicating physical tightness. Ray Dalio's social media/public statements. Leading indicators, central bank gold/silver buying data, monthly World Gold Council reports, industrial silver demand reports, quarterly from Silver Institute, currency depreciation across major economies, AI infrastructure spending announcements, Microsoft, Google, Amazon, data center builds. And here's what I'm specifically avoiding. Any investment that requires trusting fiat currency promises. That means I'm avoiding long-term bonds. Dalio's debt assets look unappealing. Unhedged dollar cash positions, silver ETFs with unclear physical backing, want PSLV or physical only. Any investment dependent on Fed credibility. If Dalio's right, Fed loses control. Ray Dalio doesn't publish year-end reflections to entertain you. He publishes them because he sees structural shifts that most investors are missing. And when the founder of the world's largest hedge fund tells you that fiat currencies are collapsing and hard assets are the only hedge, you should listen. Silver has every attribute Dalio is looking for. Hard asset with intrinsic value, can't be printed. Currency hedge, holds value during debasement. Supply constraints, production flat, demand accelerating. Industrial necessity, solar, EV, 5G, AI infrastructure. Accessibility, under $100 per ounce for retail investors. The math is brutal. Gold gained 65% in 2025. Silver gained 265%. Gold to silver ratio at 50.8:1. Room to compress to 40:1 or lower. If ratio hits 30:1 and gold rises 20%, silver hits $184, 102% gain from today. Go verify this yourself. Read Dalio's full January 6th reflection on X. Look at the S&P 500's return in gold terms, minus 28%. Check the dollar's performance against gold, minus 39%. Look at what happened when fiat currencies collapsed in the 1970s, in Weimar Germany, in Zimbabwe, in Venezuela. Hard assets win, every single time, and silver, with its dual monetary plus industrial demand, wins hardest. Thanks for watching. Leave a comment. Are you following Dalio's framework? Are you hedging currency exposure with hard assets? This is the inflection point. This is where investors either protect wealth by moving into real assets or watch their purchasing power evaporate in collapsing fiat currencies. Ray Dalio has given you the roadmap. The question is whether you're going to follow it. I'll see you in the next one. Stay sharp.